Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. It is an important day today for markets to confirm their hypothesis on a hawkish Fed. There are two important data points that are going to be released: the non farm payroll and the unemployment rate. Markets started this year on a strong note. Economic growth from the US remained robust, while labor market did not show signs of any major weakness. This resulted in investors pricing in US exceptionalism by way of a stronger dollar and higher yields. Adding to this flame is the uncertainty of policies surrounding President elect Trump. Bond markets have been in turmoil, and now maybe these data points can further provide investors with clues. Good morning, JK. How important are today's numbers? Do you feel they can trigger a new set of moves? What's your take?
Good morning, Swaraj. Yes, we are looking at the most important number from the U.S. economy. Before I come to that, the U.S. economic data and, in fact, the expectation on Trump policies have been recently overshadowed by the bond market turbulence, and it had continued yesterday, but cooled off a bit later in the day. What was on the focus was UK's bond yields, which had risen for the second successive day by more than 12 basis points, almost like the 10-year yield hitting almost 3%, just a whisker away. And then, of course, it cooled off a bit. And everyone recalls what happened in September 2022 in Britain, and after the budget presented by the Liz Truss government. And so the market was looking for a similar action, but then possibly because we have many other things lined up, Trump policies and all that, so that this market just held off further going into a tailspin. All said and done, this time the crisis or rather the bond market turbulence in Britain is not homemade. It is influenced by what's happening in the US, where the yields are rising to multi-month highs, and inflation is expected to inch higher, and Fed rate cuts are going to slow down. We don't know how the Trump policies will be. So this time it is definitely global. And in fact, speaking of global, while several countries are fighting the rising yields, China has been fighting falling yields. And today's announcement from China indicates that they have decided to suspend treasury bond purchases. So this is, which means they don't want the yields to go down further. So it has a big effect if it keeps going down further. More and more easing expected, and then inflation also goes down further, disinflation and all this. So that is so as I said, China is fighting a different battle. Probably they have taken one big step today to stop the treasury bond purchases, and after that, in reaction, there has been a jump in the yields in long-term treasury yields of China. We cannot take our eyes off the bond market, be it China or be it other major markets. But as you said, today is the focus on non-farm payroll report. We had several indicators this week on jobs. Job openings was higher. The weekly jobless claims were at multi-month low, but we also had ADP number that came below expectations. Eventually, the market will value only the non-farm payroll report, where the newly employed number of persons and the unemployment rate. Unemployment rate at 4.2% is higher than what it was 6 months back, but it is still very low in historical standards. So long as it remains at that level, Fed will not be concerned. They will remain focused on inflation. That is what one can get from this. Of course, we are also moving very close to another 10 days to go for the Trump administration. A lot of things expected in terms of the policy. People even expect some presidential orders ordering many of those policies, but market is also prepared for it. Hence, we are seeing the currencies particularly consolidating, not consolidating it. Of course, their lows are at the highs of the dollar. So that's something we will probably, even if non-farm payroll report, comes slightly deviating or worse or better, I still think the dollar may be consolidating around current levels because a bigger event is ahead. Now, another important news that we also came across was Trump is saying that Putin wants to meet him, and the meeting being set up, but no timeline has been offered. So this is news on the geopolitics, of course. Then there has been indications that many of the analysts in Japan are now moving towards a consensus on a rate rise in January. Sometime back, that was also in doubt. But the recent wage increases and also higher consumption is probably prodding the market towards thinking a rate move by Japan in January. Of course, this will also help the yen, which has been, nearing its multi-decade low. Of course, that was near 162, but we are not very far from those levels. Japan is definitely getting concerned about the weak yen. Now, coming to rupee. We made another new all-time low, but that is only marginal. And then market also really moved in a very narrow range, I would say, because the central bank was once again active. And the closing was well below the all-time highs. But rupee is not out of the woods, because we know several factors are behind the rupee's weakness recently. In fact, the clamor is that the central bank should allow the rupee to move freely, or rather allow it to fall more, which is justified by the economic fundamentals. Interestingly, two news items that caught my eye. One was the NDF offshore market positions have reached their all-time high of 161 billion. That's a 140% increase compared to previous high and previous year. And also, in the domestically, FIS are running the highest ever short position in the index. So not very good news from Indian financial market point of view, but we are just looking to see how the authorities are handling this, and particularly on the NDF market, whether it puts more pressure on the onshore rate, or whether they continue to intervene, deciding to spend more on their reserves. Yeah, let's look forward to some more movement in the next week as we head towards a Trump takeover of the government. Thank you.
Thank you, JK. And just quickly summarizing, while the West is troubled with the rising bond yields, UK especially, because yesterday it was in the limelight, investors are recalling the mini budget crisis that happened in 2022, given the rise in the UK bond yields. Rising yields have been a theme. But for China, the fight is falling bond yields. China has today announced a halt in their bond purchases to prevent the yields going further down. When it comes to the data today, we have the non-farm payrolls and the unemployment rate. Unemployment rate is expected to come somewhere around 4.2%. And the other points, when it comes to Japan, there is a rate hike expectation building up as the wages and inflation remain higher. And for rupee, we continue to trading at all-time lows. And as JK mentioned, NDF offshore market volumes have reached all-time highs, while FIIs are also running the highest short position on the Indian index. That's it from us today. Thanks for listening. Tune in on Monday for the latest in the financial markets. Have a very nice weekend.